In this set of lectures, we're going to talk about international trade and capital flows and how those work together to kind of build the X minus M component of the gross national product formula, and where the international trade and exports and imports fit into a look at macroeconomic policy. There's 6 sections, but this is actually a relatively quick chapter. The first one is how we measure trade balance, so exports and imports, trade balances in historical and international context, trade balances and flows of international capital, the pros and cons of trade deficits and surpluses, and the difference between level of trade and the trade balance. So again, these are all elements that, as we're coming up into election cycles and things like that, you'll hear a lot from some of the candidates around these issues, and it's good to be armed with relevant information to be able to evaluate those statements on your own. There's a fallacy that countries kind of can stand on our own, and we can't, almost no country can anymore, and sustain a level or standard of living that's going to be considered even humane by today's standards. We're all part of a global financial system, which includes a lot of different currencies. So here on the screen, you can see the British pound. Down here, you can see the euro. You got euros here, you got dollars, you got yen, the renminbi, which is the Chinese currency, or the yuan. So you've got a lot of major currencies, and those are going to be the major currencies. And then you've got a ton of other currencies, whether it's the Mexican peso or the Canadian dollar, that also Swiss franc, that also play into all those currencies. Those currencies can get traded, and we're going to talk a little bit about that in this chapter, and also how those currency trades impact import-export flow. So the first thing we need to do is, when we're talking about trade and in economics, we try and measure everything, is we'll define the term, and then we'll talk about how it's measured. So measuring trade balances, the trade balance is the gap, if any, between nations' imports and exports, so X minus M. What the value of that is a trade balance. Sometimes trade balance is positive, sometimes the trade balance is negative. In high-income countries like the United States, goods, so things like computers, cars, cell phones, etc., comprise less than half of a country's total production, while services, so restaurant services, accounting, legal, education, comprise more than half. So high-income economies are surprisingly less about the consumption of things and more about the experience of things, and that's where a lot of the production occurs, as an experience rather than in stuff. When we look at trade balance, there's a couple different ways to look at it. The first way is a merchandise trade balance, which only looks at goods, which again, when you're thinking about large countries and kind of high income countries, that's going to really limit the amount that you're actually looking at, because less than half of your production is actually in goods. But there's merchandise trade balance. There's a current account balance, which is a broad measure of the balance of trade that includes trades in goods and services, as well as international flows of income and foreign aid. So if we're sending foreign aid out to Morocco, for instance, that's going to show as an export. If we're showing income in from investments in euro bonds, that's going to show as flows of income in, or imports. So that's your current account balance. And then you've got unilateral transfers, which are payments that government, private charities, or individuals make, where they send money abroad without receiving any direct good or service. So you see this a lot of times with immigrants here to the United States. They'll send money back to Vietnam or to Mexico or to Guatemala to help their families. Those are unilateral transfers. When we look at trade balance in historical and the international context, and we go up here to graph A, it shows the current account balance and the merchandise trade balance in billions of dollars from 1960 to 2020. There's a few things to kind of focus on here. The first one is, when we look at all the way up till about 1976 to 1980, but really 1976, the United States current account balance was generally fairly stable at zero. So we were importing, exporting about equally. That began to spread, but you can see that the numbers here were relatively low, and you had a relatively close association between the current account balance, which includes goods and services, and the merchandise account balance, which just includes goods. So services, we were exporting, more, and tend to export more services, which is why the merchandise account balance shows lower. When you move out here, though, you can see both of them tend to decline rapidly, particularly in the mid 90s. You had NAFTA, North American Free Trade Agreement, signed in here, where it became much easier for us to do imports from Mexico and Canada. You had the rise of the internet, which allowed more virtual work and global work. And then you can see that, starting with the 2008 financial crisis, we continued to see the merchandise trade balance go further into the negative, where we saw, a kind of step up on the and a spread between the merchandise trade balance and the current account balance. So you can see that we're exporting, significantly more in the way of services than we are in goods. When the lines are above $0, we're running a positive trade balance and current account balance. If they fall below $0, the U.S. is running a trade deficit. And you'll hear presidential candidates talk about the trade deficit and it's bad and we need to get rid of it and we should put tariffs in. And we'll talk about that in the course. That's probably not going to be, from an economic perspective, the best move. It may be a political move, but it's probably not a good economic move. And then you can see that the current account and merchandise trade balance as a percentage of GDP has continued to decline over time. So that X minus M has continued to be a relatively growing portion of the calculation of gross domestic product. The interesting thing here is you can see that services, when you add services back in, we see a pretty good pickup. So the U.S. is a net exporter of services, net importer of goods. That's one of the takeaways here is we're a service economy largely. We've moved away from manufacturing, certainly since the rise of the computer. But what we substituted in has been our ability to export services, whether that's intellectual services, educational services, etc. Exports of goods and services, a percentage of GDP, is a measure of an economy's globalization. The higher this number becomes, the more globally interdependent the economy of that country is, and how critical the global economy becomes to that country's economic viability. And you can see this is not atypical from a percentage basis. As we've seen kind of the end of the Cold War, which occurred back here in around 1990, countries have embraced more open and free trade, which has tended to create more of those interdependencies. So when we talk about trade balances and flows of financial capital, the financial capital is international flows of money, or it's flows of money. In this particular case, since we're talking about trade balance, it's international flows of money that facilitate trade, investment, and commerce. So capital is generally money, and it kind of flows around. When we're talking about financial capital, you've got human capital, you've got infrastructure capital, but we're talking financial capital, which is money. The connection between trade balances and international flows of capital is so close that economists sometimes describe the balance of trade as the balance of payments, because again, if you're trading something, you got to pay for it. You're generally going to pay for it in a currency, whether that's the currency of the seller or the currency of the buyer, and that's going to impact foreign exchange rates. But so you can have this balance of payments or balance of trade, because again, the two are going to highly correlate, given that you have to pay for the trade. The category of the current account balance involves a corresponding flow of payment from between a given country and the rest of the world's economy. When we look at flows, and again, economics is a discipline with a lot of graphs. And so you'll see me use graphs and charts and other things to try and make it easier to understand. And so if you take a look at this and you think of the home country as the United States and you think of the rest of the world as the rest of the world, you can see that we'll make foreign investments, we'll send money out to the rest of the world. We'll pay for our imports, so we may import semiconductors from Taiwan, we may import cars from Japan and Korea. And then the rest of the world and again, when we pay for those imports, they're gonna send the imports over. They're also gonna buy exports from us, and they're gonna pay for those exports. So you can see, here's goods and services, and this is financial capital, and when you go to the bottom side, you've got foreign investment in the rest of the world, and then that comes back in the form of dividends and other investment income received. Then we've got, others make investments in the United States, so there's investment from abroad, and then we pay dividends, interest, and other income back out to those investors. And so you can see that it's a constant flow, and the system is always generally in balance. And we'll talk about why, because it's pretty interesting on how foreign exchange rates and the flow of financial capital tend to force everything to balance out. So like anything in economics, you've got a supply and you've got a demand for financial capital, and there's interest rates and rates of return and exchange rates that are pricing mechanisms, and supply and demand will kind of force those into equilibrium if the systems are allowed to operate that way. So balanced trade is balanced payments. Current account deficit means the country's a net borrower from abroad. United States, as you saw, we show a negative current account deficit, so we're a net borrower. Conversely, a positive current account balance means the country's a net lender to the rest of the world. Inflows and outflows of foreign capital doesn't necessarily refer to a debt to governments or other governments. It could be companies, it could be people. Government debt might be part of that. But the international flows of financial capital refer to all the ways in which private investors in one country may invest in another country. So you've got real estate, you've got buying companies and securities. You've got financial investments like stocks and bonds. There's a lot of different ways to invest. The interesting thing is when we're buying all this stuff, let's say from Japan, we're buying all the cars from Japan, we're sending dollars over there to kind of buy those cars. Well, now Japan's got a bunch of dollars. So what are they going to do with those dollars? Well, they've got to do something with it. They're going to have to use those dollars somewhere. So they're going to use those dollars to theoretically buy things or invest in things in the United States. And that's where the foreign exchange rate comes in. So national savings and investment identity is the total private savings and public savings. So if you've got public savings, that's a government budget surplus. We haven't seen one of those for about 30 years or 25 years. But that's private savings and public savings. So it's the supply of financial capital equals the demand for financial capital. Supply and demand are going to be in equilibrium. This is an economics class. So savings by individuals and firms plus imports minus exports. So kind of the trade deficit. So this is going to be imports minus exports equals private sector investment. So savings equals private sector investment minus or plus the net public savings. And so if this is negative, if the government's running so this is government spending minus taxes collected. So if the government's running a deficit, that's going to impact this by essentially reducing the impact of private sector investment, because this becomes a negative number. Supply of that's the demand for financial capital. So you've got to cover off how much private sector investment, and you need to cover your um, your government budget deficit. So by definition, if you have a government deficit here, it's going to reduce the amount that's available for private sector investment because you're doing public sector investment. Supply of financial capital equals demand of financial capital. So again, these need to balance. So if government spending is greater than taxes, government is going to demand financial capital, which means it's not available for private investment. If taxes are greater than government spending, then the government is a contributor of financial capital because there's excess money here. So they're either going to be paying back bonds or making direct investment. So you have some countries have sovereign wealth funds that make direct investment in companies. So again, when you hear things about like the United States government deficit or national debt or federal debt or state debt, that's actually impacting the amount of money available for private investment because we're using it essentially as a direct investment in our government as opposed to private investment. The connection between domestic savings and investment to the trade balance explains why economists view the trade balance as fundamentally a macroeconomic phenomenon. So it's, we're looking at domestic savings and domestic economic activity, and now you've got this, kind of trade balance that needs to get covered off, and as a result, that becomes money that's not invested currently in the local economy. In the case of the trade deficit, national savings and investment identity can be rewritten as the trade deficit equals domestic investment minus private domestic savings minus government or public savings. So T minus G. So again, if there's a deficit here, this becomes a positive number, which will impact the trade deficit. The only way that domestic investment can exceed domestic savings is if capital is flowing into a country from abroad. So the only way that domestic investment can exceed domestic savings here is if you have excess capital flowing in, if you have net imports. In the case of a trade surplus, and again, the United States, as we saw on a graph several slides ago, we haven't run a trade surplus in nearly 50 years. But in the case of the trade surplus, national savings and investment identity can be written as trade surplus, X minus M equals to private domestic savings plus public saving minus domestic investment. So domestic savings, both public and private, is higher than domestic investment. So our savings is higher than domestic investment. And the extra financial capital that shows up here, so where you've got kind of this and this, and they're not in equilibrium, that extra financial capital, as I just talked about, I said, we buy the cars from Japan. Japan has these dollars and they don't know what to do with it because it's in excess of their, they basically have a surplus. At that point, they're going to invest that abroad. They're going to take that money and they're going to put it to work somewhere else. There's no other opportunity to do it in Japan because they're essentially in equilibrium. They've got excess capital coming in. What do they do with that excess capital? They're going to invest it. They're going to look for opportunities abroad to invest that capital. So when domestic investment is up, and there's, so we'll look at trade balance as one factor at a time. National savings and investment identity provides us a framework for thinking about what causes trade deficits to rise or fall. Domestic investment minus private savings minus minus public savings is a trade deficit. So domestic investment minus savings minus the public domestic savings, which is taxes minus government spending, equals the trade deficit. So if domestic investment is up and there's no change in the private and public domestic savings, then imports minus exports must rise. So essentially you've got to have the trade deficit going up. If there's no change in domestic investment, private domestic savings is going up and public domestic savings isn't changing, then the trade deficit's got to be falling. And if there's no change in domestic investment, no change in private domestic savings, and public domestic savings is going down, so the budget deficit is rising, then imports minus exports, the trade deficit must also be rising. So if you want to, if you kind of go into the presidential type of arguments that we saw in 2016, 2020, 2024, if you're saying domestic investment's not changing and private savings isn't changing, if you want the trade deficit to get better, you actually have to have the government spend less, or you have to tax more, and that's going to drive your trade deficit down. Short-term movements in the business cycle and trade balance in the short run, whether an economy's in recession or in recovery, can affect trade imbalance. Recession tends to make trade deficits smaller and a trade surplus larger. Combination of changes in interest rates coupled with less domestic consumption will cause exports to rise. Well, a period of strong economic growth tends to make trade deficits larger and trade surpluses smaller because, again, you have excess money being generated during economic growth, so we're going to tend to buy things from other countries and import them in. They're not hard and fast rules, but there's a strong correlation. So pros and cons of trade deficits and surpluses. For countries, in and of themselves, there's no merit to an economic policy of not participating in capital markets. And you can see that when you look at a country like North Korea, which really doesn't participate in any of the capital markets. They've been frozen out either by their own choice or by sanctions. Their economy is not a robust economy. They suffer through shortages. They suffer through starvation and privation. So there's no benefit to not being a participant in global financial capital markets. It makes economic sense for an economy to borrow from abroad in some cases, as long as it wisely invests the money that's being borrowed in ways that'll tend to raise the nation's economic growth over time. So U.S. in the mid-1800s, we took a lot of foreign investment from Europe in particular that allowed us to really jumpstart from an agricultural economy to an industrial economy. South Korea in the 1970s saw the large influx of foreign borrowing and investment, which drove South Korea from being very much a near third world nation in the 50s, 60s, and 70s to one of the most dynamic economies in the world today. That was done because of targeted investment. Borrower nations can find themselves in trouble if they don't invest the incoming funds from abroad in a way that leads to increased productivity. So if you basically bring that money in, and they've got examples of Mexico, Brazil, some African nations in the 70s and 80s, if you bring that money in and it's not used to actually grow the economy, but it's used for short-term political gain, for graft, for corruption, that is not going to drive additional growth in the economy, and that lack of additional growth in the economy is going to make it difficult to pay that money back, and as a result you'll have sovereign wealth debt defaults. And so again, this is an issue where foreign borrowing is not necessarily bad, and some of the work that the IMF, the International Monetary Fund, and the World Bank do is not necessarily bad. You'll hear people say, "Oh, it's horrible," or it's globalist, or they're being oppressive to the Southern Hemisphere. Not necessarily true. It's how that money is being utilized by the folks receiving it that tends to show a very strong correlation with their ability to both pay that money back as well as show growth over time. And really it's a combination of factors, but we've seen both really strong uses of that for investment in the economy, and then we've seen poor uses of those borrowings, which have caused bigger issues down the road. A country's level of trade tells how much of its production it exports. So it's a separate term from balance of trade. If it's got a high level of trade, it may have a balance of trade that's zero, but it may have a very high level of trade. Because it's got a large amount of exports, and then it's got a large amount of imports. And so the balance of trade may be zero, but the level of trade could be in the trillions of dollars. That's measured as a percent of exports, as a percent of GDP. Three factors strongly influence a country's level of trade. First, the size of its economy. Obviously, if it's got a big economy like the United States or Japan or China, those countries are going to have the ability to have a strong, high level of trade because there's a lot being produced. The geographic location, again, when you think about, you know, economies, northern hemisphere tend to be, if you look at a globe, there's more land mass in the northern hemisphere than the southern hemisphere. Northern hemisphere countries tend to be able to trade easier. They've got more land borders and water borders. And rich countries, when they're close to each other, tend to be able to trade easier. So that also creates, you know, some geographic location, and then you've got natural resources, and then the history of trade. So again, if we've had countries that have traditionally traded over the years, like U.S. and Japan, even pre-World War II, those countries will tend to continue trade, you know, going forward. We're establishing new trade routes, and new trade relationships takes time. And again, it's some of that's just a function, those of you who have been in business know, and just human relationships know, that it takes time to build those relationships and then have those relationships bear fruit. There's been a long history. That history tends to create norms for trade, which then facilitate additional trade. So some discussion questions, some shower thought questions. You know, of the following countries, do you think they have a high or low level of trade? Sweden, U.S., Japan. You know, they're going to be at different levels of trade, but you can kind of think through that and try and think through why when you look at these three factors. A few final thoughts on trade balances. Trade deficits can be a good or a bad sign for an economy. It's really, so can trade surpluses. It really depends on how those surpluses are being used as part of the investment in that economy. So in and of themselves, trade deficits aren't bad, trade surpluses aren't good. We don't necessarily need to be at zero. As a matter of fact, we may not want to be at zero. So again, you'll hear politicians talk about, you know, trade deficit's bad. Not necessarily. You know, how are we utilizing that trade deficit? How's that money being reinvested back in the United States by the other country that, you know, where they've got the trade surplus with the U.S. What's the standard of living? What's the strategic factors associated with, you know, not having that production on shore? So some of those elements just need to be thought through. There's no simple answer. Even a trade balance of zero, which just means the nation's neither not a net borrower or a net lender, can be good or bad. Or, you know, it doesn't, again, there's a lot of nuance to this that goes beyond like trade deficit bad, net borrower bad. Fundamental economic question here that you need to ask yourself. And again, I want to get through in these course lectures that, you know, it's not simple black and white stuff, economics, politics, any of that. It's not simple black and white stuff. So when you are analyzing what you're reading, what you're hearing, you know, what people are telling you, the kind of roll back to the economics of it if it's a economics oriented question, but even if it's not, kind of roll back to the fundamentals and go, you know, in this particular case, the fundamental economic question isn't whether an economy is a net borrower or a net lender, but whether the use of that borrowing or lending in that particular economic situation makes sense and is providing a return to the beneficiaries, to that country's citizens, to that country's economy. Is providing a net benefit or a net drain on that economy, and that answer is usually going to be far more complex than what you're going to be able to get in a 140 character tweet or a 30-second